Welcome to the CBRE Investment Management Listed Real Assets or Core webcast. Please note this call is being recorded and all lines have been placed on mute. If you'd like to submit a question, please do so by clicking the Q&A icon on your screen. Live captioning is also available by clicking the closed caption icon at the bottom of your screen. I would now like to welcome your host, John Treitel. John, the floor is yours.
Great. David, thank you so much for that introduction. Very much appreciate it. And I very much appreciate everyone's time today who's dialed into the call. If you want to think about the backdrop of the last 2 years, it's been a remarkably dynamic period of time for listed real assets, for private real assets, for markets in general, all in the wake of an unprecedented rise in central bank interest rates in order to combat inflation. As we get towards the end of this year, that hiking cycle is closer to being behind us. Listed real assets in particular are on the move. And we've gotten a lot of questions here specifically on listed real estate and listed infrastructure. We have our panelists here to answer those questions for you, our very human, non-generative AI panelists to answer those questions. Dominic Garcia is our Chief Pension Strategist at CBRE Investment Management. He's the former CIO of New Mexico Para. He leads our efforts to think about holistic real asset solutions for our institutional clients. Ken Weinberg is our CIO of Listed Real Estate. Ken has 3 decades worth of experience across listed real estate and private real assets. He's a global portfolio manager on our strategies. And Jeremy Ignagnos is our CIO of Listed Infrastructure. He incepted our flagship infrastructure and sustainable infrastructure strategies. He also leads our commingled real asset strategies that invest across the spectrum of listed and private real assets. In terms of the topics for this call, we hope you get a sense today of our thoughts on strategic allocations across real assets, precisely why we're so excited about listed real assets today, and how we're positioning for potential success in our strategies. It's going to be a moderated Q&A. We've gotten a bunch of questions ahead of time here, but please continue to submit them over the course of this call. And if there's anything that we're not answering directly, please reach out either to me or to your client solutions representative in order to set up an individual call. So with that, welcome everybody. Thank you for joining. Dom, I'd love to kick it off with you first. Maybe if you could just speak a little bit about what our clients are asking us about strategic allocations in real assets broadly, and then what are they asking about listed?
Thanks, John. It's a pleasure to be here. If I may, if I can start first taking a step back, maybe start with a few of the comments that you started with. I think we first kind of believe if we think we're kind of in a new kind of investment landscape, a new paradigm shift, if you will. So if you think about where we are, this is something that we haven't really experienced in our careers, most of our careers. We have to really go back to pre-1992 eras to really understand kind of where our investment landscape is. And in that new shift, in that new paradigm shift, we think structurally higher rates and higher inflation will be kind of the norm going forward on a long-term basis. So from a point of view of that, I think it's important that investors who have been conditioned to really think from a nominal point of view really need to start changing mindsets to real investors. And so when I talk to a lot of our clients, that seems to resonate and they get that. So the questions we get really aren't why real assets kind of fit and should be kind of an anchor to your portfolio. The real questions we get are really about how and what, right? So how do you actually define real assets? It's kind of a sprawling asset class. How do you actually think about that? Where's the starting point? How much should you allocate to a total real assets? What are some of the best practices for implementation and putting it all together? And so those are some of the things that we're working on with some very large clients, pensions, sovereign wealth, insurance, and endowments. And so when it comes to listed, that it really becomes that question of what's the role? Where's that role of listed in that strategic long-term real asset allocation? And from our research and our work, what we find is in that long-run solution, we believe listed REITs and listed infra is your starting point. It's your starting point of that allocation, and it's basically part of your core portfolio somewhere around a quarter to a third of that total allocation. And then thereafter, you build out your private allocations beyond that initial starting point of your listed. And so in effect, the listed in that strategic allocation kind of serves as core, as a liquidity sleeve, and is kind of your first initial exposure. And or some investors think of it as even potentially a completion on the other side of it as well. But in effect, it's that starting point in that core for your broader long-term strategic allocation.
Great, thanks, Tom. I appreciate that. And then maybe Ken, kind of asking you the question in a similar vein, how are our clients turning to us on the listed real estate side?
Yeah, and as Dom alluded to, we're actually managing some very large recompletion strategies. I think about our conversations today, they're really emphasizing the next generation exposures of real estate beyond the traditional sectors of office, retail, industrial, and apartments. Some of our private indirect real estate funds at CBRE are further investing in our listed real estate strategies, really given the potential for superior total returns and that more diverse opportunity set that listed offers. I think more broadly speaking, I know today about 2/3 of the top global plans use REITs in their real estate portfolios as part of the real estate allocation. And then I guess in terms of the main reasons that investors are speaking with us today or allocating with us, it usually revolves around core real estate access, completion potential, and then obviously liquidity.
Got it. Great. Thank you, Ken. And then Jeremy, maybe turning to you a little bit. We've talked a lot about holistic infrastructure over the course of this year as well. Maybe how you're thinking about how our clients are looking at listed infrastructure alongside private allocations.
Yeah, we see increasing interest for listed infrastructure, not only from institutions, but also high net worth investors and retail investors for exactly that strategic core allocation that Dominic talked about. And it really has to go to the fact that it's an all-weather asset class. It has had very competitive returns to the broad markets while providing consistent income and at a lower level of standard deviation than the broad market. So you're enhancing your risk-adjusted return. And in the way we see, institutions in particular look at the asset class is really complementary. Listed infrastructure can obviously add that liquidity benefit that Dominic referenced, but it also can provide just immediate exposure and broad exposure to the diversified group of sectors and geographies and regulatory and contract environments. And in today's marketplace, providing that at a discounted valuation level. And then just reminding investors that, when you're looking at investing in a new fund that is going to be going out and competing in a relatively scarce asset class where there's a premium demanded for assets, the listed market provides that exposure in a very deep and large liquid asset class where you just buy right into an existing, operating asset, cash flowing, all of the positive attributes of infrastructure.
Got it. I appreciate that. And then, the follow-up question that we tend to get is, well, what's the right mix? And so Dominic, I think we did our best to answer that last week at the CBRE IM Symposium. We presented our sort of recommended model portfolios and real assets. Maybe you could talk about how we approached answering that question and what some of the results were.
Yeah, so if I may, I alluded to in my initial comments, what clients are really engaging with us on is the how and the what's, right? How do I define, how do I allocate, and what's the right allocation? So I think maybe the starting point is to tackle that first question, and it's kind of fundamental question of how do I actually define real assets? Where does it fit, and how do I build, right? So we offered maybe a 4-point matrix to consider in defining what a real asset can be. And so I think the first point is kind of inflation protection and or liability matching, meaning that the asset has the ability to adjust and perform well and is well correlated to kind of inflation increases over time, or it has an ability to match or hedge some liabilities for LPs. So I think first of all, I think that's a key component and a key matrix. The second is, when you think about real assets, you're really looking for diversification relative to your growth of your equity portfolio. So we got to make sure that's sustainable and that's true, and that plays through in the data. The second is, or the third matrix that we like to use when we define is that there's more of an income-based component to your return stream, and more importantly, kind of a real income-based component. And part of that is that you don't really sacrifice total return. So if you're diversifying with equities, you don't want to sacrifice total return of your equities or your total return expectation. And the last thing is if real assets is going to be kind of an anchor in your portfolio, as part of a big component of your portfolio, we think liquidity is important as well. So what we've also put on there is, so on this matrix, there's probably at least 5 kind of asset categories that most investors think about when they think about allocating to real assets. So obviously real estate, infrastructure, and then credit, real asset credit, and natural resources. So natural resources would be things like timber and agriculture, and then your traditional kind of fixed income tips and commodities. What we find in just kind of this 4 matrix box that real estate, infrastructure, and real asset credit kind of tick all those boxes pretty nicely, and the natural resources, tips and commodities, kind of a gray area. And the gray area for natural resources really is kind of that total return. So for instance, in timberland, total returns or expectations are lower than what you would expect otherwise in real estate and infrastructure. So you sacrifice a bit of return. And the same is true of tips and commodities. In an unlevered portfolio, you're going to sacrifice total return with allocation. So that's something to keep your eye on. So for us, we started with this matrix and kind of came with that 3 asset real estate, infrastructure, and credit real estate to come up with what we think is kind of the optimal portfolio. And so when we took these 3 assets, and if you may maybe go to the next slide, what we did was we said, okay, let's take these 3 assets, let's put it in a multi-asset framework, and let's really think about 10 years forward, and how can we really allocate and optimize a portfolio with these 3 real assets, asset categories, in combination with stocks and bonds and a total plan perspective. So one thing that we've done, just to give you a sense of kind of what, how we approach this, we've also, we made sure that the public and private are on an apples to apples basis, meaning we kind of de-smooth kind of private indices to make sure that, you're not getting the, incorrect kind of risk allocation or smoothing effect. And so what we've done is we really started what we consider to be kind of the market universe for an investor, and that turns out to be that bar chart here on the left, which is the market portfolio. So real assets in that universe is 11 to 12% total today. But what we did is we applied those assets that I described in our definition and reapplied it to that portfolio. And what we find is optimally you get to about a 24% baseline and up to a 38% max portfolio when you kind of unconstrained real assets in that. And all along that, your Sharpe ratio or your expected Sharpe ratio improves markedly. So I think the takeaway is that we think when you unconstrain a real asset portfolio in a multi-asset world, you get up to about a 38%. But we think a baseline of that is about a 24% allocation. So it's a key anchor and a key component of the total portfolio going forward. And if I may, John, maybe just to give a little bit more insight and zoom in on kind of where those allocations are. So maybe I want to highlight maybe 3. So for the asset class, the difference between real estate and infrastructure, we actually lean a little bit more into infrastructure. We allocate about 55% plus into infrastructure, just simply because of the diversification benefits and the income component of infrastructure is quite attractive. And then most interestingly, as well as I highlighted, is listed, it turns out to be about 25 to 30% of that strategic allocation long term. And then we do believe, a risk profile predominantly of core plus should be about 2/3 of your allocation, and then enhanced allocations, call it opportunistic ish is the remainder. And so those are kind of the zoomed in portfolios that we found over time. And we think that that portfolio is quite optimal and attractive.
Great, thanks, Tom. I really appreciate that. I was really impressed with the development of that sort of baseline portfolio, as well as the degree of flexibility that it has in sort of adjusting the optimizer to individual client constraints. And so I'd impress on everybody, for further follow-ups, if you're interested in looking at that as it relates to your own individual situation, please follow up with a call. Dominic, that was very much an outlook on the strategic overlook in terms of baseline portfolio. Maybe you could just speak a little bit towards maybe tactical augmentations, particularly with regards to listed. If you think about our recent CBRE House View as an example, that is very listed forward, thinking about preferred strategies at this point in time. So how can you think about listed on a tactical basis alongside the strategic comments that you just shared?
Yeah, so strategic, and again, those are long-term 10-year views, right, or 10-year horizons. So I think in that vein, the systematic exposures of listed and private, they generally kind of converge over that time period. So we do think that that's kind of a holistic long-term strategic allocation, but we do believe there should be tactical bands, right? And the tactical bands should be, hey, let's recognize that points in time there might be opportunistic points to overweight, underweight. Your core plus, your enhanced, and particularly your listed, right? And I think those times are particularly around kind of valuations. Is there an opportune time to enter your strategic allocation and or flex into that flex that strategic allocation, above that call it 30%, based on valuations. I do believe that that time is kind of now, right? That there are some attractive valuations for listed. And so if you want to vary or extend or flex that strategic allocation to an upper band of your tactical allocations, that is probably about a now assessment in that long run kind of 10-year horizon.
Great, I appreciate that, and I think it's a great point to speak to the now, with the listed real asset outlook in particular. Thinking about 2024 and beyond, but even before we get to 2024 and beyond, Ken, Jeremy, maybe just speaking towards November of 2023, a very strong period for listed real assets for our strategies. Generally, we're up approximately 10 to 12% on the month. What do we think about that move that we've just kind of had in listed real assets, and when we think about the duration of the opportunity for investors? And Ken, maybe we could start with you on it.
Sure, happy to, John. And you're right, they have bounced off the bottom, but we believe there's a multi-year opportunity with the stock still down, roughly 25% over the past 2 years, despite what's been solid earnings growth and dividend increases, as well as we sit here today with the companies with strong balance sheets that potentially could take advantage of some distressed opportunities surfacing in the private markets.
Great, thanks, Ken. And Jeremy, maybe just turning it to you for infrastructure.
Yeah, even with the really strong bounce we saw in November, the asset class is still down negative for the year and kind of underperforming the broad equity markets by 17%. And so if we finish the year negative, that will be 2 consecutive years of negative returns. The last time that happened was about 20 years ago. And then it preceded a very strong bull run for the asset class from 2003 to 2007, above 20% annualized returns and outperforming the market by about 11% on average. So I don't think that you've missed it. I think that, the valuation setup and earnings, as we'll talk about, still look very attractive, even with, a good bounce, but just bringing us back to flat, for the year.
Great, thank you. And Ken, just on the real estate side, maybe getting into the details of that a little bit further. You mentioned real estate stocks still down significantly over the interim period here. What does that imply from a valuation perspective? Historically, how have they reacted when they've hit these levels?
Yeah, well, the stock still traded double-digit discounts to private market values, even after we've haircut our views of NAVs by over 20% to really incorporate higher return hurdles in a higher for longer interest rate environment. And then if you look historically, these types of discounts have led to double-digit prospective returns over a multi-year period. And then if you look from a multiple perspective, REITs are trading materially discounted relative to broad equities, while historically they've averaged closer to parity. In terms of a catalyst, history would suggest that a Fed pause is an important one that typically leads to attractive prospective returns. But I'd also note that even in a higher for longer interest rate environment, REITs can deliver attractive returns. If you look back at the period from 2002 to 2007, when rates were at similar levels, REITs delivered an average annualized return of about 15%, far exceeding that of broad equities. Finally, I'd point out fundamentally REITs are in a position of strength with earnings that continue to be solid and meeting expectations, and balance sheets that are at fairly low leverage levels in the mid 20% range.
Got it. Thank you. And Jeremy, we had a related question with regards to the Fed here. Specifically for infrastructure. Thinking about yield sensitivity, do we need to wait for the Fed to cut to actually invest in infrastructure?
Yeah, no, and it's a good question because as we saw this year, it certainly weighed on the asset class. And we've seen that in short periods of time, even though long-term infrastructure really has no correlation to bond market returns. In the short period, you see it can have a disconnect. But I don't think investors need to wait. Really, what we see is the pause is one of the key catalysts. It changes kind of the perception and the sentiment. And in a higher for longer environment of interest rates, infrastructure can actually do quite well. That bull market run that I talked about in 2003 to 2007, that was a period of elevated 10-year Treasury bond yields over 4%, kind of the range that we're in today. And just reminding everyone that the broad framework of regulation and how regulated returns work is a pricing off of some effectively a risk-free rate. It takes time for it to flow through, but it will start to benefit the companies and offset, of course, higher financing rates, which will also take time to come through because of the long duration of their debt profiles and whatnot. So that coupled with, we think the earnings resilience of 8% earnings growth the companies are delivering or plus into next year, and the highly discounted valuation where we're well below 1 standard deviation to our long-term average on a multiple versus the broad market. Those catalysts along with that pause, I think, are going to be quite favorable to a potential return outlook.
Got it. Thanks. I think your point that infrastructure returns set upon the cost of capital have the potential to actually rise with a higher for longer interest rate environment has been relatively overlooked. Have you started to see signs thus far in terms of fundamentals responding to that rate regime with an upward bias?
Yeah, we have, and they're marginal. We have to be fair that for the U.S., let's take the U.S. utility market as an example. ROEs, allowed return on equity, bottomed 2.5 years ago and has been steadily increasing the last couple of years. But we're up kind of 20 to 30 basis points from the bottom. Obviously, rates have moved a lot more, but those returns never fell all the way down with rates either. So at a 9.7 ROE where we are today, you saw upwards of 12.7 in that period when 10-year Treasury bonds were back in 2003 to 2007. Not saying they're going to go all the way back up to that level, but just to give you a sense of how the range has been and where they lived over time. And then, yes, some marginal improvements the last couple of years.
Great, thanks. And then maybe kind of Ken related to you, thinking about a potential regime of higher for longer. We hear a lot in terms of negative sentiment or headlines about refinancing distress in real estate. Maybe you could speak to how REITs are positioned, what more recent refinancings have been. Love to get your thoughts there.
Sure. We think REITs are positioned quite well, John. They learned some tough lessons during the global financial crisis, but they came into this downturn with historically low leverage ratios, sitting roughly in the mid 20% range, largely fixed rate debt with significant term. REITs currently have an average liability duration of nearly 7 years, which is going to minimize the earnings drag of higher rates for years to come. It's early days, but we're also seeing some evidence that REITs are using their strong balance sheets to acquire from privates selectively at fairly attractive pricing. And that's probably an underappreciated point and potential catalyst, and something we expect that's going to increase in the years ahead. And then ideally, if current REIT discounts turn into NAV premiums, as we've seen historically at the beginning of other cycles, earnings growth can be materially enhanced behind kind of the largely organic growth that we've underwritten for the companies today.
Got it. And so related to that sort of acquisitive growth that you referred to what extent are we underwriting those in our current estimates when we look ahead to 24 and 25?
Yeah, those are obviously difficult to forecast, and some of it's contingent upon varying cost of capital. So there's negligible amounts embedded within our mid-single digit earnings growth today. So that would only be incrementally additive to the story if they were to surface. Great,
thank you. And so then maybe moving a little bit from the asset class discussion to more of the strategy level. Jeremy, I'd love to start off with you speaking towards the infrastructure strategies. Why do you believe that we have the potential to outperform when looking ahead?
Thanks, John. Always happy to answer that question. I think we have a very clear and defined way that we think we can add value. And it really starts with our definition of the asset class, which is poorly defined across indices. And our definition allows us to align the investment universe with the private infrastructure market. So we are able to get exposure to and maintain close research proximity to markets and assets like data centers and towers and integrated utilities, investing in renewable generation and things that are very secular opportunities for growth. So that gives us this investment potential set. And then we have looked at how we can add value, and it's through identifying, of course, well-positioned companies, but diversification's always been very important to our process, by region, by sector, by regulation, by factor, and that hasn't played as well, I'd say, in this kind of post-COVID rebound, where there's been, particularly as you saw this year in the broad equity market with the Magnificent Seven, we saw something similar in infrastructure, where just a very narrow set of sectors and companies have performed well, and a more diversified portfolio, and you see that in the indices as well. More diversified indices haven't performed as well. So we think that there's reversion potential in those sectors that have lagged, and a lot of the thematics that drive them continue to support it. And our more diversified approach, I think, is which has worked in the long term, is likely to come back into favor as we see some of that just reversion to the mean of some of those sectors that have lagged.
Got it. Are there any particular sectors that you'd like to call out within that? Is there anything in the more recent earnings season that's perhaps instructive to think about the potential path of things to come?
Yeah, I think certainly there's been, it's not a secret, it's been negative headlines this year on renewable investments, and for things maybe not even associated with what we invest in, but just the headlines around offshore wind in New York and kind of projects being walked away from, fears of cost pressures and supply chain. So any utility that had that activity, which we would bucket in what we call the integrated utilities, have lagged pretty sharply. Based on all the things we've been hearing from them and the outlook, we believe that they are very well positioned to continue to invest and make very strong returns on those projects, benefiting from the IRA that was passed, in the summer of last year. So there's one. And then on the communication side, again, there's been, particularly in the U.S., less so in the international market, but the U.S. communication stocks, particularly towers, have lagged very sharply versus expectations that they can continue to drive secular attractive growth, and trading at one of the sharpest discounts we see across infrastructure to the private market. So those are two areas in particular that we think they're have lagged but have the potential to revert and provide positive outcomes.
Great, I appreciate that. And so Ken, maybe turning it to you, maybe speaking to our listed real estate capabilities, preferred sectors and positioning as we enter 2024.
Sure. We're trying to manage for consistent alpha and balancing our exposure across fundamental factors. I think, one of the reasons that our REIT strategies delivered top decile performance across the pandemic period, which if you think about it, was really a series of risk on and risk off markets, which is this general fundamental factor awareness and balance and constantly evaluating the portfolio for the best risk adjusted return opportunities. We do take high conviction bets. I think if you look at some of our top performing holdings this year, such as Park Hotels and some M&A names such as Spirit Realty and Life Storage, those were non-consensus views, and we had some peer leading bets in terms of scale of the positions. Thinking about where we see the opportunities today, we'd agree with Jeremy on communications. We've been aggressively adding to towers as they underperformed earlier in 2023 and recognize the significantly discounted valuations today. I think we also have a non-consensus view on the storage sector, which is a space we've been able to generate significant alpha historically. And we expect to do so again, given the discounts that we're seeing today in a sector that private capital would like to own more of. And, we see the potential for a solid earnings growth story, admittedly decelerating off of some, record levels during the pandemic.
Great, that's fantastic. And so that's pretty much what I had here in terms of moderated questions. Turning to those that we had submitted ahead of time here. One that we got, and Ken, I think this belongs in your wheelhouse. How long is the window to enter real estate at a discount? How do you think about timing in the cycle?
Yeah, that one, obviously always difficult to predict, and every cycle is going to be different. But I'd say on average, it can take a year to get back to NAV premiums. And then once that's achieved, it allows the public companies to be buyers in scale of opportunities in the private market. And that could be a multi-year opportunity. And, typically it comes at the beginning of a cycle, so you're getting attractive pricing.
Yeah, thank you. And I'd also just call back maybe to your earlier comments too. When stocks have been in this double-digit discount regime for an extended period of time, forward annualized returns are effectively high teens on a 3 to 5 year basis. So just in terms of thinking about the duration of that opportunity. And then next, Jeremy, I feel like you've already answered this a little bit with regards to conversations about integrated utilities, but do we consider renewables core towards listed infrastructure and listed real assets?
Yeah, and I think it's worth kind of just breaking that into for a moment because certainly we see the opportunity to invest in the energy transition is a big part of the need for investment broadly across infrastructure. And when you take a renewable asset, a generation asset, and you tie it to a long-term contract, you've now created part of the unique benefits that the infrastructure asset class provides. So we do see it as a core area. We see tremendous interest from private market investors. There are a few billions of portfolios for sale right now from some of the listed companies. They typically build them and then sell up to 50% to kind of finance and then move on to their next project. That interest has not abated this year, and it's from the largest pension funds to the largest private equity backed closed-end funds to our own CBRE investor groups looking at these assets. So I'd say there's very broad interest. And the benefit, I think, in the listed market is that these are some of the largest developers. They have tremendous scale of an investment in this asset class, which gives them, I think, a lot of ability to manage some of those challenges that have arisen the last couple of years. But manage them quite well.
Great, thank you, Jeremy. And then one thing I'd add on with too is when we've seen transaction and privatization activity occur for listed infrastructure assets. I mean, we've effectively been seeing some of those renewables assets transact at effectively 5 to 6 EBITDA turns above which their implied values are trading in the listed market. So it's a sizable valuation signal from the private markets in terms of the underlying value in these assets. So Ken, two questions that we've gotten, retail related. The first one is retail back. And then related, can we provide thoughts on malls like Simon Properties, asking for a little bit more detailed data there and how we're positioned. So maybe just kind of a comment on retail and what we think.
Yeah, we do believe, and we're hearing it from clients, we're starting to see renewed interest in retail. Clearly went through a decade-long cleansing process. But I think one of the benefits of that, now that we believe we're on the other side, is you've had virtually no new supply come through, and that all of the retailers that were challenging heading into the pandemic have generally been washed out. So the fundamentals are solid, and obviously cap rates are at a higher level, and you're getting fairly steady growth. And so I think that's generating a renewed interest in the sector. And we could see that continuing. Obviously, you have a lot of high quality portfolios within the listed space across the spectrum of types of retail that allow us to kind of pick and choose where we see the best risk adjusted opportunities.
Great. And then I think related for you, Ken, as well, two questions on office. So they're coming in twos. Is office rebounding or is the worst to come? And then secondly, how do we invest in the public REITs without office exposure?
Well, the latter question is fairly easy. I think if you look at the opportunity set within the public market today, the listed markets have already spoken. Office only represents roughly 3% of the opportunity set. So in terms of concerns about exposure to office, it's just not material within the listed space. Fundamentally, are we on the other side yet? No, I think there's clearly secular challenges that are out there. We believe we've incorporated them in terms of how we're underwriting things. Clearly, long-term diminution in demand we have to think about. And so, we continue to evaluate there's some high-quality public companies that are being impacted by that and trading at very discounted valuations relative to the private market. So we'll certainly consider them, but, fundamentally, things are still challenged there.
Got it. Thank you. And then, Jeremy, I think this is one for you. Again, on renewables, what's our view of renewables in the event of a more conservative presidency? How has the IRA impacted infrastructure thus far?
Yeah, that's a really good question and very topical. We see that being asked among our clients. And just a few things to remind everyone that the IRA has been far more beneficial towards Republican states than Democrat ones since its inaction. States like Texas, Florida are some of the largest areas of renewable development. It's also where most of the job creation has gone, and there are others. There are some forecasts out there that we're going to publish in our Outlook piece later, but just to know that it is a significant benefit to a number of the Republican constituencies, and so that just seems to me to be not likely to go well if somebody goes to try to repeal it. There are areas, IRA was very broad and it covered, things around EVs and EV charging and other areas within, clean tech and clean energy. And I think there are areas where perhaps there's a stronger link to China that there might be more pressure on to push back on. But I don't think the actual development of renewables and manufacturing, by the way, there was a lot of impetus to bring manufacturing on to some of the components that go into these assets onshore. Again, those are job creators, they're economic drivers. not usually where politicians want to go and start pushing back on. So we view it as a very low risk in relation, particularly to the areas that our companies are investing in. And it can't say it's a zero risk, but unlikely in our view to be something that gets targeted.
All right, great, thank you. And then one related to inflation. If inflation has peaked, should we still invest in real assets? Jeremy, maybe just sticking with you, and then turning to Ken.
Yeah, and that certainly is the signal that the markets are giving. Is part of why the rates are falling, and less pressure on the Fed to continue raising rates. So that a headline I saw from some strategists today was mission accomplished, and we'll see if that's the case. But certainly, infrastructure and I think real assets broadly can do well in a generally low inflation. It will just mean, of course, that rates will continue to go down, which becomes again that potential tailwind. We are still benefiting, by the way, of inflation capture, which is usually on a lag of some period for those revenue streams and catch up that the companies get to generate on the infrastructure side. So in the near term, I think we're still catching up to the inflation of this year as we go into next year. And in the longer term, if low inflation continues, it just means lower rates, which I think would probably outweigh, from a market performance perspective, the fear of lower inflation.
Got it. Thank you, Ken. Anything you wish to share on listed real estate?
No, I think Jeremy summarized it well, and all the positive attributes that Dominic highlighted earlier, and certainly the valuation considerations that we talked about are in play here. We think the catalysts are there for potential for significant outperformance.
Great, thank you. And then one last question that we got in here. Comparison of the market cap of listed infrastructure compared to listed real assets or REITs. Maybe Jeremy, you could take that one. Speak to our own universe relative to benchmarks on the infrastructure side, and maybe just the listed real estate universe more broadly.
Yeah, so the listed infrastructure universe is about $4 trillion, $4.25 trillion, somewhere in that range of equity market capitalization. That's upwards, probably more than $7 trillion of enterprise value. So you've got a pretty broad, diverse and liquid market. And then Ken, you'll have to remind me on where the global listed real estate universe sits market cap wise. Ken, do you have that number?
Yeah, it's effectively about $3 trillion on a global basis.
Right.
That's correct.
So it's slightly larger, but combined, you've got a pretty significant listed real asset universe.
Great, and this is the last one too, Ken. If you comment on the wide divergence of the returns so far between private and public real estate. I think we mentioned a little bit of this at the outset of the call, resulting valuations and what forward returns have been. But maybe if you could just kind of speak to that. Obviously, quite topical.
Yeah, I just say this is not unusual. The public markets are doing what they typically do in terms of whether it's uncertainty or pressures on private market valuations. The listed markets tend to shoot first and figure it out later in terms of where the right values are, and they tend to overshoot. That's historically been the case, and we have a long history of looking back at these types of periods. And what also tends to occur is they tend to rebound even while private is still finding its floor. And so I think we're in that period today. And obviously they'll meet somewhere between at some point. But as we've also shared in prior periods, at the beginning of the cycle is when REITs typically tend to have the cost of capital advantage. And if they do, they could potentially be buyers of some challenges in the private market, which is accretive to the overall growth story.
Great, I appreciate that. Well, look, I think that wraps up the questions that we received. Again, if there are incremental things that you'd like answered, please reach out either to me or to your CSO officer. I'm happy to do these calls on a one-on-one basis, happy to share the materials that we presented over the course of this call. just kind of summarizing, I think Dom really gave a great view on strategic allocations in real assets, effectively a 24% allocation to blended real assets, roughly 70-30 mix strategically long-term between listed and private, with the opportunity to augment that on a tactical basis. I think you heard from Ken Weinberg about the discounts in listed real estate compared to private markets, the opportunities for future returns, those that we've seen in historical periods following those disconnects, as well as the underlying earnings outlook there with preferred sectors. I think Jeremy gave very much the same view for listed infrastructure, thoughts around catalysts with the Fed pause in the hiking cycle, the resiliency of overall earnings and income, as well as some very topical points concerning both renewables and communications, and thinking about positioning for 2024. To all our participants, thank you very much for your thoughts. For all of our attendees, thank you very much for your time. And if we can be further helpful for you in your research of real assets, please do let us know. Thank you.